The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Good evening. Welcome. My name is Adam from Trade with Precision, and welcome to this evening's webinar brought to you by Trade with Precision and ATFX. We're going to be talking about applying technical analysis, obviously, in the Forex market. 5 tips in using technical analysis. So the first thing I'd like to do is just do a sound check, make sure that you can hear me, and that I make sense to you, of course. So if you can, please feel free to respond in the questions box. Just send me a response there to let me know. And then we can sort of kick off. I can see that there are still more and more people joining, so just waiting for that. We can slowly start to proceed through the disclaimers. I have to bring you a moment to read these. And while you're doing that, I'll tell you a little bit about myself if you're interested. So I am a London-based trader. I'm also a swing trader, which means that I'm trading predominantly the daily timeframes. I will take you through, if you're interested, I'll take you through a few of the markets that I'm looking at in terms of trading opportunities now and a few trades I'm actually in. And we'll do, if there's anything in particular you would like me to have a look at, I'm more than happy to do that. And so I'm a swing trader. I'm also a trend trader. So I will trade any market, but it has to be trending. And usually I will take my entries on the daily time frame. That's what a swing trader is. On occasions, I'll look for an entry on the 4-hourly or potentially on the weekly. And I'll actually take you through an example of the 4-hourly and the weekly with gold later on. So also, I'm always curious. Feel free to tell me where in the world you're listening in from. I'm always curious. I'm based out of London this evening. And occasionally I'm in Portugal or Spain, obviously because I can. And let me know if you're brand new to trading as well. So it's usually these presentations are ideal for traders who are either brand new to trading or starting their trading journey, or also traders who have got intermediate or maybe more experience, who are looking to become more consistent in their trading results, or even people who are wanting to just chat to other traders. So you're always welcome to do that. There's also another risk warning here. Just give you a moment on that and just have a look at some of your comments. South Wales, fantastic. Cornwall, beautiful. And everything is good. Okay, fantastic. All right, great. Yeah, I'm originally from, although my mom and dad were from the UK, I grew up in beautiful Cape Town, worked in Johannesburg up until about 10, 11 years ago, and then moved over to London. And I don't intend to stay here forever. I do ideally look to retire on the Mediterranean and go where the sun is, of course. But so that's my background story. And I think we can kick off and have a look at this agenda. There we go, South Africa, fantastic, lovely. So we've got another Sapphire on the call. Brilliant. Good. And okay, so agenda. So I've got sort of 5 tips. In fact, chances I'm going to give you more than just 5 tips. I'll probably look at about 6 or 7 things that I want to cover with you. 5 tips in taking technical analysis to the next level in the Forex market. Also have a look at why the Forex market is a good choice for technical traders. Okay, have a look at, definitely I think what's very important to cover tonight is when not to trade. Right, because that's something that maybe, if you're not familiar with it, that we need to discuss, is why there are certain markets that we would just leave alone until the conditions improve. So that might mean that we leave the market alone for the next few hours or maybe the next few days. All right, so we'll also have a live look at the top trending currencies right now. And in fact, the interesting thing is there may well be opportunities setting up, swing opportunities setting up between today and tomorrow. So I'll take you through that. I'll take you through the rationale, the logic. What I would like you to take away at the end, at the top of the hour, at the end of this webinar, is a much clearer sense of how trading is meant to be. It's not smoke and mirrors. It's not voodoo. There's no mystery around it. It's common sense. It's very practical. It's evidence-based. Right? And we're talking now about trading for a living or trading to earn a secondary income as well. And of course, you can have your questions answered in real time by a full-time experienced trader. And as soon as he comes on or she comes on, I'll let you know. That was just me making a very bad joke. All right. Let's have a look at your comments. Fantastic. So there's a couple of South Africans on this. I love it. Okay, great. I know we are everywhere. I mean, you throw a rock anywhere in the world and you'll land on a South African. Anywhere in the world. Paris, Canada, you name it. We are everywhere. Which is interesting considering that there's only about 6 million of us outside the country. The rest are all inside the country. But anyway, just considering we're everywhere. And everybody goes, oh, I know a South African. I have a South African friend. Kind of like saying, oh, I have a pet somewhere. Anyway. So again, we've covered this. Let's carry on and move on to this. So there's usually these slides at the end. We will come back to this at the end in terms of just introducing you to ATFX if you're not familiar with them. What I'm going to do at this point in time is go across to the platform. All right, so I'm just going to remove, there's a couple of things that I have removed here. The platform that is being used is an MT4 platform. All right, so what's nice about MT4 is that it's used by a few different types of brokers, but the key thing about it is it's actually relatively simple to use. It's very primitive, but primitive in a good way. It doesn't break down. It doesn't break down. It's used by a lot of traders around the world. They can create tools which they can share that can be added to the platform. It's pretty simple to learn how to use. If somebody is teaching you how to do it, they can show you how to use MT4 within an hour. You know, it's pretty quick and easy. And there's replications of things. So obviously I've got the items that I can trade on the left-hand side, which I can access through my symbols list. Okay, so I can switch things on and off through that. The more I have in there, the more it'll use up bandwidth. And I can add in indicators from the menu here. I can also add in indicators from the menu up here. I can also add them in from up here as well. So I can create charts from this area. I can right-click and create charts from here. So basically, there's a duplication of orders. I can change the time frame up here, but I can also right-click and change the time frame from over here. So it's just a variety of different things, but it's pretty much replicated there. And we'll start off with that. Okay, so what I would also like you to do, please, is to take as many notes as possible. I'm going to be giving you a lot of experience and tips. And also some of these I may make a few comments that are pretty much my opinion and not necessarily that of Trade with Precisions or ATFX's. Okay, so because I'm really going to be speaking as an independent trader, this is really the point, is what I want to cover here. So what I'm going to do is I want to start off with, we'll start off with a blank chart. Okay, so I'm going to start off with a blank chart here. And what I want to do is I'm going to cover the following points. Okay, so the key points that I really want to get across with you this evening or today, depending on where in the world you are. Actually, I don't think I got enough of an answer. Can some of you give me an indication if you are in the first 6 months of your trading journey? If you could do that, just to give me a sense of, because then what it means is I know how simple I need to make my kind of language here. And one of the keys to successful trading is much more about doing the simple, basic things very well, much more than it is about complexity. A lot of people think that look, there's a thing called universal experiences, which basically is to say that most people who do, if not all people who go through trading, go through the same experiences. Okay, it's universal for everybody. But at the time, it doesn't feel universal. It feels, if something happens to me, it feels like this is just my bad luck, or this is something I had to learn, or I had to figure it out, or maybe I'm struggling a bit here and there. Everybody goes through the same experiences. Okay, everybody's probably moved their stop loss once, maybe risked too much, maybe avoided getting education when they should have been educated. You know, everybody starts out not knowing what this word means or what the language is, especially if we're from a non-financial background. Everybody in the entire financial industry starts out not knowing anything about it, so they have to learn it. So I'm just saying, don't let that be anything that gets stuck in your head thinking that that's what makes it difficult. It's not. In essence, trading is not the same as investing. We are looking effectively at catching fish, so to speak. We're looking for conditions where we can go out there, find the right conditions. We're looking to get in and get out and take money as we go. And this is not scalping. It's really about there'll be a reason to get in and a reason to get out. Okay, we'll have a fixed entry, a fixed stop loss. So I'm covering very high-level concepts that I want to cover with you today, but they should have a big improvement if we follow them. Okay, so amongst the other items is I want to cover price action and trending. All right, so the point of that, I'm looking at your comments. I'm just reading your comments quickly. Okay, cool. Okay, good. All right, so the point being is that about half of you are in your first 6 months. Okay, and some of you are more experienced. All right, so absolutely no issues there. Let's cover it. So the first thing that what I'm going to do here is we're going to be technical traders and just go through this list and then I'll go through it in more detail. So we're going to talk very much about understanding about, as traders, we can choose the market conditions that we participate in. Our success, our probabilities of success, let me rephrase that. Our probabilities of success come from picking the right market conditions. If we pick a market that is clearly trending in a very healthy fashion, and that's all we ever do, the odds are that the probabilities of the market's going to continue in that direction. We should make profit. Then it'll come down to details. Then it'll come down to the right entry, looking to take profit as we go. Okay, but the key thing is very much understanding that we choose the market conditions we trade, okay, which also includes knowing what not to trade. Then we're going to also talk about horizontal levels, so that basically the most experienced traders can literally just trade with those two items and make money. That's all they need, because at the end of the day, that is the most important information on any given chart. Then we're going to also talk about higher time frames as well, and also moving averages. Okay, moving averages to help us identify entry opportunities as well, and trade and risk management as well. So this is relevant for, especially for beginners. And we've got about 48 minutes, give or take, in which I'm going to brain dump a lot of information on you. Okay, hopefully you're ready for that. So we start off with a clean chart. Okay, so every trader, doesn't matter what the chart is. I'm going to start off on the daily time frame. Okay, so why the daily time frame? Well, the daily time frame is generally the most analyzed by traders, historically always has been. And the daily time frame says a lot about what potential trading opportunities there are in the markets. Okay, so this gives me a sense of what's going on in the market. Don't worry, it's going to look a lot cleaner by the time I'm done with it. I want to be operating with a clean chart. So I'm going to hit Control G, which gets rid of the grid. I need clarity. All right, so if you've ever, for those of you who like clean desks or clean rooms or a clean house, you'll know how much less stress there is when you come home to a clean, or if you're in a clean environment. Basically, a less cluttered environment. Our brain is constantly thinking about everything. It's constantly monitoring in the background our unconscious and conscious brains. Okay, and our unconscious brain is constantly looking at all the details. So that's why one of the issues I have with so much advertising today is wherever you drive, your brain is constantly looking at advertising and paying attention to it. It's distracted by it. It's noise. So when you go out to nature, it's fantastic, because there's one of the things you won't notice that isn't there. It's advertising. Simply the amount of background power, CPU power, that our brain expends trying to monitor advertising is ridiculous. And it's a joke. When I was a kid, they used to do these these futuristic sketches of what the future was like. And the one thing the two things they left out of that was how many people would be on the planet at that time. And the second thing they left out was how much advertising would be everywhere. I mean, just everywhere. It's ridiculous. It's just very brain intensive. So my point being is that a clean chart actually we won't necessarily know it at first, but it actually help us focus. Okay, it's less effort to focus because there's less of the things we need to look at. So we start off with that. We start off with price action. All right, so price action conditions matter because some conditions are untradeable no matter how good you are, and some conditions are more tradable. So let me take you through. I'm keeping the chart like this. Look, you can see what other charts look like. So this is what the chart will ultimately look like, but I'm starting with this because I want to build up from the ground up for those of you. So I said it before, I'm going to say it again. Success from trading comes from doing the simple things, the basic things, the building blocks really well. It's not about complexity. It's not about more indicators. It's not about the lower time frames. It's not about overthinking it. Success from technical analysis trading is ignoring the news, looking at the chart, focusing on a nice, clean, simple chart, and being sensible about getting in and getting out. That's what I want you to understand or feel that you get by the time we're finished tonight. So let's start running through a few different charts, okay? And we're going to have a look at this. I've kept it green and black for now because what I really want you to focus on is the last 20 to 40 candles. Okay, so there's the last 20 to 40 candles. That's more than 20 or 40. But the last one of those is because why? Because, and we're on the daily time frame, because that is what conditions are that I have to consider looking for a trading opportunity in today. Okay, so let's just zoom out a little bit and let's do this. And we're going to do this to kind of get a sense of where the potential trading opportunities lie. So I'm just going to delete that. What I'm really going to be focusing on is the last kind of period of that. So if you look at this, there is a trend. It is producing lower highs. It is producing lower lows, but it has very deep retracements. So if I look at that and then I compare that to this market, there's a difference. There's a big, big difference. This market does not have as deeper retracements. It's actually a lot more steady in its flow. It's a lot calmer. All right, it's a lot clearer as to what it's doing. So if I had to choose between those two charts, this one will win. So how many trades am I looking to take per week? What's a realistic expectation? 2 to 5 trades per week. I'm looking to take 2 to 5 trades per week, ideally yielding a net profit of 1%. I'm being conservative here. There are way more than 2 to 5 trading opportunities per week, but I'm looking to have a net profit of 1%, ideally. Okay, so out of those 2 to 5 trades max, 1% net, which should compound to about 5% per month. This is realistic and achievable. At least I want to give you a sense of what a professional would anticipate to expect. And there's a big difference between trading for yourself, trading a small amount of funds, and trading a large amount of funds. If you have $1 billion or £1 billion to trade, you're going to have a difficulty not impacting the markets that you want to trade. So trading smaller accounts, a 10 million account or a 5 million account or a 50,000 account or a 10,000 account, as we come down, we have pretty much zero impact in the major markets. So that's good. It means that actually in a way the potential for us to earn is higher. It's not unusual if a trader makes 12% in a month, but if a hedge fund made 12% in a month, that would be a big concern. Okay, so we don't look to the hedge funds or the banks or the S&P to give us a sense necessarily of what we're supposed to be making. Individual traders, if you do your research, especially if you read the Market Wizards series, so there's a couple of books that you have to read. You have to do Trading in the Zone by Mark Douglas. Let me put that on the list. You can imagine how much I'm trying to throw your way now. So Trading in the Zone by Mark Douglas is a must read. It's very easy to read, and it teaches you all about the experiences that every trader goes through. You'll read it and go, holy cow, I thought I was the only one who'd had that experience. So that's Mark Douglas. Okay, then Jack Schwager had done a whole series of books called the Market Wizards. Sorry about that. Market Wizards books, okay, by Jack Schwager. Those are great to see people, to learn about people from all walks of life who've been successful in creating, starting from, some people were artists, some people were musicians, whatever, non-financial people as well as financial people, and Jack Schwager, and then at least those two for now, or at least learn about those two there. So that's what we're looking to do. All right, and it's not unrealistic to do that. So let's have a look at some more market conditions. Okay, so it is very much just looking at the price action can tell me whether I should get into market now or not. Let's have a look at Australian dollar against the US dollar. Let's have a look at that. Okay, so if I compare the 3 charts I've had so far, this is the worst one. Okay, although it is generally bearish, it's going to be a lot more difficult for me to make money in this chart because there's no steady flow of money. It's what we call momentum. I'm looking for clear momentum. Okay, so let me give an example or some clear momentum. Let's see if I've got something here. I haven't put everything in. Let me have a look at some of these charts. What's dollar Sing looking like? It's looking bullish. Let's have a look. I'm looking for something with a very clear momentum. No. Okay, that's good. Potential. Just trying to think of a few different markets as well. What else have I got in my symbols? Bag of tricks. Okay, so that's fine. We'll work with these just to try and draw that in. I was looking for something with a strong downtrend. Okay, again, this is a problem. Why is this a problem? Because, and I realize that the color here isn't great, this is stuck within a range. So the difference between this, and let me go and change the color so that we can see it. In fact, I'll tell you what I'm going to do. I'm going to change the color. Just bear with me because there is method in my madness. I'm going to Miyagi you. So we'll do this one. So we'll make the, we'll do all of this as white. Okay. So bar up, bull candle, bar down. That's fine. Okay, and then we'll just change this block over here and make it a darker color. I'm guessing. There we go. All right, cool. So we're stuck within a range here All right, so the problem with this is there isn't any one clear side in charge. Now, throughout my earlier education, which was about 4 or 5 years, trying to kind of master things and figure things out, the problem was that I was jumping between so many different strategies. I was learning how to trade trends, how to trade counter trends, how to trade ranges. So there's a lot of reasons why people might like to trade ranges. But here's the problem with trying to do ranges and counter trend trade and trade trends. You sit and look at every single chart going, can I squeeze out a trade here? And so you waste time, because it becomes exhausting to look at every chart, every time frame, and try to figure out if there is. Whereas if we are, for example, and this is my personal opinion only, if I'm only focused on trending markets, it's a simple yes or no. Do I trade this chart or not? And this would be a no. So I can move on. The speed at which I can move through the charts. And also, if there's nothing on the daily, there's nothing on the lower time frames. Okay, generally speaking. If there is a good trend on the daily, there's generally a good opportunity on the lower time frames. So let's look through a few more of these charts. Let's go through this again. This is not ideal. So let's have a look. Kiwi dollar is on my watch list, and I'll walk you through a few of these so that it'll make sense to you. And euro dollar is on my watch list. And overall, you can see this nice trend. Look at cable. Look at GBP. Not really going anywhere. The one that was looking the nicest in terms of the cleanest downtrend was Kiwi dollar. It's currently got a very nice, strong, clear downtrend, although it was within a range. Okay, so once we've done that and once we've established it, what was gold and silver looking like? Gold is a little bit more, silver's heading down a little bit lower. Gold, it's got a bit of a cleaner uptrend recently. It's had some good trends over there. And just having a look at those in terms of currencies, and we can run through a few of these. So let's actually start by going back to euro dollar. I wanted to show you what I constitute as a really good trend, and we'll start to talk about candlesticks and price action as well. Okay, so we can have a look at price in bars. These are called OHLC bars. We can also look at them in terms of candlesticks. I'm going to go with candlesticks, and I'm just going to change the look and feel of these. Now, why would I want to do candlesticks? Well, because visually they're actually a lot easier to, sorry, that should actually be red, and we'll do this as lime. So we'll just do a bull candle that way. Volume will take away the color there. Okay. And what else is missing here? Volume, no color. That should be fine. Foreground, bar up will be, bar down will be red, and that will be, let's do bar up, and that'll be bar down, red. There we go. So I've got up and down candles, that's fine. If I go through, to bars and go through to candles, I get a lot more information. Okay, this gives a lot more information, especially much better visually for beginner traders and experienced traders. It's a lot easier to determine what the market conditions are like as well. The next thing that we need to do is, yes, there are there's a series of books, Japanese Candlesticks by Steve Nissen. There's Price Action by L. Brooks. There's a lot of stuff out there, but the stuff I've given you is the stuff you need to start with. That's the most important thing. And really what we need to do now is understand a few key things about the markets. Okay, this is also want you to pay attention to this. Is everyone with me so far? Is this keeping you interested? Silence. Everyone's quiet. Okay, so basically what we want to do is understand the difference between trending and not trending. Okay, so any market, any time frame is either going to be in one of two states. It's either trending or not trending currently. And if it's not trending, I want to stay away from it. And if it's trending, it's either going to be trending up or down. And then that's fine. That helps me determine which way I need to go. Okay, when it comes to candlesticks, which is included in here, so with candlesticks, okay, they are basically one of three categories. Okay, they are either bullish, bearish, or indecisive. Almost in a way, a summary of all the trading activity that took place inside that candle forming. Okay, so that they're either bullish, bearish, or indecisive. So if we run through this, if I just have a look at these. All right, these last two candles here are clearly bullish candles. Okay, they're clearly bullish. This big red candle is clearly bearish. That's clearly bearish. And then we can start to have a look at a few of the mixed ones. This red one over here, let's just zoom in. This red candle over here is actually, although it's red, it's been rejecting the lows. And actually, if I just put a line in, you can see where it was rejecting it, that's actually a bit of a bullish candle. This is a bearish candle. This is a bullish candle. This one's actually bearish. Well, it's called the gravestone doji, but the names are not too important. What we need to understand is collectively they are generally bearish. The next thing that we want to be aware of, so that's one big nugget of information. The next thing is that these indecision candles, these sort of dojis, spinning tops, various different names for them, basically where they have a long wick on either side of the body and a small body, generally we call those indecision candles. Okay, they tend to occur at the tops and the bottoms. Okay, so these turning points at the top we call swings. That's a swing high. This is a swing low. Okay, and there's a swing high again. They will tend to occur at those turning points. That's going to become relevant in a moment. All right, if the market is ranging, you will see more indecision candles because the market is undecided. Okay, so if you go to a market that's going largely sideways, you'll see many more of them because that's the kind of conditions where you would find them. Cool. So that's important. So we need to understand that in an uptrend, in a nice healthy uptrend, we are looking for bullish candles as because they should be there. Right? In a downtrend where it's bearish, we should be seeing more bearish candles. Okay, and so if we go and have a look at some of these markets, let's go and have a look. US oil, we could see that's a bullish candle. I know it's red, but it's bullish. Okay, that's bullish as well. So in an uptrend, we've got nice bullish candles. They make sense there. Okay, at the tops, we might have some bearish candles, maybe. But in a downtrend, we'll tend to get very bearish candles. It's the color and the shape as well. So to me, this is a bearish candle, obviously, because it's red. This is also a bearish candle. Okay, and they make sense within the context of this trend. They make a lot more sense because they should be there in a downtrend. So funnily enough, once I pick the right type of conditions, everything else kind of falls into place. Well, obviously in a nice healthy uptrend, and it's healthy. How do I know it's healthy? Because its behavior is stable. Think about all the crazy people that you know in your life, and think about all the non-crazy people, the stable people. Okay, picking, you have to think about it because it's a relationship. Every trade you get into is a relationship that you have with that trade in that market. And you need to think about how much pain and suffering you want. Do you want lots of pain and suffering? Then get into a crazy market. If you find yourself getting into a crazy market all the time, then you have to think about that because then there's psychology involved. Why are you choosing a difficult relationship with the market? Okay, what we want is we need to have relationships with healthy markets to be successful. We have to do that. So there's a lot about our behavior that will become apparent, all right, if we are self-destructive. Okay, sometimes we do that. There's a big aspect to it. A lot of people, for example, think that they're the only ones who have low self-esteem and everybody else has normal self-esteem. And actually most people, like 90% of people on the planet have very low self-esteem. Okay, there's like a 90% chance that everyone you talk to every day has low self-esteem. Even the people who talk with big mouths, low self-esteem. In fact, usually they're more so than anyone else. So you pick up these things. And the point is that this is relevant to us as traders on our personal journey and psychology as well. So there's a question here saying, just to be clear, our bullish candles are actually bearish. Now hold on. So let's talk about the color and the shape. Although this is a red candle, that wick, that push is telling me that the market, almost like a firecracker wanting to go up, it's wanting to shoot up like a shooting star. That is actually relatively bullish in its behavior. Although it is red, it's mostly bullish because of that wick underneath, that shadow underneath, that's what we call it. Here's a green version of it. It just so happened the only difference between the two is the market happened to close above the open here, and it didn't quite make it in that session. And this session here, it's a little bit bearish because it went up and it got pushed back down. So although it's green, the collective behavior is that the bulls tried and got pushed back down by the sellers. And then they went down lower, but then they got pushed back up. So collectively, the story is here. The market went through a bit of a battle, and then eventually the bulls won. And that's fine because the market will go up, pull back, and then go up and pull back. And when it goes here, you see a consolidation. All these patches here, the market is not very weak. There's a massive amount of bulls and bears here battling it out, bulls and bears battling it out, bulls and bears battling it out, and then the bulls win. The overall trend is strong, and then they ultimately win. Yeah, exactly. So, okay, so I want to keep on mind because we've got 29 minutes left and I'm still really on point one, but it's not all about that. I've thrown a lot of stuff in so far. The point is price action, clean trending price action is best for us. So let's go to the euro dollar one because we're talking about currencies today. So although these have got these deep retracements, we are looking at overall, we can see the momentum is heading down. And then what I'm going to do here as well is throw in Kiwi dollar because I quite like this as well. So this one is currently, the currency markets can go through trending and non-trending phases. Okay, so they can often go through strong trends, then they can go into uptrends. Now it's going sideways. Now it's started a downtrend. They can go through various ones, especially when we start to look at different markets. For example, this one currently is not trending. So all it means is I don't have to do this very often. I can just focus on this every other day. This market here is not going anywhere, but you can see by the price action here, it's very bearish currently. If it did have to start trending, I would not be surprised, but it would still it needs to break free of this range. So this is all pretty standard behavior. You can see here, there's a bit of a level here. I actually added that level in there, but there's also a bit of a level here. Once we break free of this, we'll start to see a trend a lot better because it gets stuck within a range. Let's look at Euro GBP. Got a bit of a mess going on there at the moment, so we can run through these. You can see here, shorter term moves to the upside. So potentially one way in which traders might look to trade this, potentially if they can frame price action, okay, is they might go, okay, this is potentially going to head to the upside, go down to say the 4-hour time frame, and maybe look for a trend to the upside. Okay, so we're looking, there's a bit of a method in the madness here, but overall what we're ideally looking for is a nice solid trend on the daily. Okay, I was going to say something very similar to these types of conditions. Okay, this one overall very choppy at the moment, so these are the kind of conditions I would just stay away from. There's no money to be made in this, and there's no professionals. And it's interesting because the professionals are very orderly in their behavior. So you can tell when a trend is nice and healthy, you know it's the professionals trading because, first of all, they're only interested in trading good markets. They're going to trade where the money is easy. That's what you're going to do, and the money is easy when the trend is nice and strong. So here you can see good uptrend here. I like this. It's looking nice and bullish. Obviously, it's had good trends in the past. So we always go through phases where the market will have trends and not trends. And so the trick is to only focus on the ones that are trending today if I'm looking for that. This one you can see is now stuck again between that range. There's a range here. Right now, there's a range there and there's a range up above that. It's stuck between that. There might be shorter term opportunities for day traders between the top and the bottom where it's trending. So what does this look like if I go down to today's 5-minute window? There's the 5-minute window, 15 minutes as well, potentially. A bit of a trend, but all really helps me is defined mainly by that daily. Okay, cool. So clean price action, trending as often as possible. Try to stay away from ones that are completely messy. The candlesticks will start to make more sense in a moment. Then we talk about horizontal levels. So this is how I go about framing price action. All right. So basically what I'm looking to do, if you think about it as almost like a map, I'm looking at the chart from above, I'm looking down, and I'm looking to mark off the areas where price goes, because as traders, that's all the markets really are. We think sometimes that what moves the market is Trump speaking. It might cause a spike, but what actually moves the currency markets year in, year out is the interest rate differentials between them, okay, or the trade policies. That's the stuff that moves it in general. It flows. On a week-to-week basis or over a short period of time, it might get stuck on something, but generally speaking, it is not the news that drives the market. There's actually an underlying market. We mustn't forget this. It's very important to remember that the currency market is made up of banks that have to hold foreign currency. When they buy gold reserves, when they buy anything from any other country, they have to pay, they have to exchange that money as well. It's made up of companies paying suppliers. When we order stuff off Amazon or off eBay, there's an exchange rate there. It's off tourists exchanging money. It's off hedge funds investing as well. There's so much going on, and everybody thinks that it is just Brexit and just Trump, and it's not at all. They are a small factor in the big picture. It's very important to remember that. So trend traders will be cautious of potentially news that might interrupt a trend. So what that means is if there's an economic calendar, and so there might be FOMC out of the US, which could cause disruption in the currency, so we would not trade around the news. We're looking for a trend that is not going to be interrupted. It's kind of safer to trade when the market is just going in a direction and we're just piggybacking on it to look and make money that way. So we actually avoid trading the news, because trading the news is a lot more like gambling. Trading for real is when we look for a trend and we just piggyback on that trend. So we're not trading against anyone else, we're just piggybacking, we're in the shadow of the giants. Okay. So key levels help us determine what's going on. Generally, the way that it works is once we can identify those key levels, once price breaks to that level, the next most logical thing for it to do is to go to those next levels. And why are these levels so important? This is where it gets really interesting, because a lot of people think there's all this voodoo and stuff around it. There isn't. It's all junk. At least on a day-to-day basis, that certainly is the case. I'm not saying that nobody in the history of trading hasn't ever tried to mess with the market, but on a day-to-day basis, there isn't any funny stuff going on. And a big part of that is that the big fish, the people with really big orders, someone who's buying 300 million euros today for a hedge fund or for a bank, they can only get their orders for that so much money. They can only get their orders filled at these key levels. Okay, so what they might have to do, for example, is they might have to scale in. So sometimes if you're in the market and you see very, very steady pattern, it's almost robotic and geometric in its shape, that's usually someone who's needs to buy 100 million, but they're not getting their order filled by the banks. So what happens is they're buying in 15 million, 30 million, 45, and every 10 pips, they're just buying. And so or every pullback on the 5-minute chart, they're just buying again. So they get their orders filled slowly. But you'll often see why the market goes to the big levels. That's where the big fish can do transactions with other big fish. So in other words, these levels have a lot more transactions and volume happening on with really big whales who are trading with each other. And generally, the market will move from one level to another. Okay, so as traders, all we're doing is looking for a good trend, and then we're looking to trade it as it goes from one level to another. The meat on the bone, so to speak, where we make money is the area in between these levels as price is trending from one level to another. Okay, so we need to learn to identify those levels. That becomes very important. And one of the ways in which we do this is by starting on the monthly, daily, and weekly. These are the areas we really need to get nail down those levels. So I'm just going to remove them and start from scratch. We're going to start with the euro dollar, and then I'm going to finish up on that. I'm also just going to have a look at, so I'm using the euro dollar as my key thing. And we're doing okay in terms of time, I have to say, so far. Good. No, thank you very much for saying that. No, the whole point is I went through the whole program. I went through the program, and then I hear somebody saying, oh, well, this happened because of that, and this happened, and it isn't. And this, believe me, I want you to think about something today. If you think about any industry in the world, there are some people in those industries who really know what they're doing. So think about a car salesman. Okay, one car salesperson or saleswoman, doesn't matter, car salesperson is very good at selling cars. The other person is only doing that job to put food on the table. Their heart's not in it. They don't enjoy doing it. Maybe somebody else is doing a job because their dad did it or their parents did it. So the point is that within any field of career, there are people who do it because they're very good at it. And they're usually a very small portion of that. So in any given company, there are people who are just there to get paid, nothing more, and other people who are really good at what they do. It's the same actually in this industry. I see people who provide analysis in the web out there. They're providing it on some very big brands. This is not ATFX. I'm talking about other websites as well. And I look at their charts and I can tell you they're not traders because there's so much on their chart you can't see anything. And the most experienced traders have less on their charts. They'll just have horizontal lines, price action, moving averages. They will use Fibonacci on occasion or pivot levels. So they use those because those are historically very reliable. And the tools they use are like 90% reliable, not 50-50 or something. So when I see someone who's got Bollinger Bands on and trend lines and CCI channel and 5 indicators at the bottom, and it's a bird's nest, like a spider's web, and then I know they're not real traders because, and they're giving you 10 different ways the market can go, then that's not how it works. We can see which way the market is probably going to go. Okay, so right now we can see that. So let's go on to the monthly here and let me frame price action. These are the key levels I want to keep an eye on. I like areas where prices tested it from below and above. Okay, that's a good level. It's quite significant. Yes, you can get two levels that are close to each other. It is possible to sometimes get two levels close to each other, but you have to decide that we're also going to focus on levels where the market cares about these levels right now. So if we go down here, you can see there's definitely a reaction at these levels here. I'll just drop a little bit just so that I can kind of tick that box there. That's good. I like that very much. There's also another level down here. So I'm focusing really on price close to where price is now. Then what I'm going to do, okay, there does appear to be something a little bit here. I'm going to go down to the weekly. Okay, go down to the weekly and just zoom out here. I don't want to obsess. I don't want to have too many lines on my page. And by the way, another tip, one of the best times to draw these lines in and to do my analysis in my first year or two of trading, or 6 months anyway, is on the weekend, when there's no fear that there's a trade going on another tab somewhere that I'm missing. Just do it on the weekend. So it'll just, it means that I can relax 1 or 2 hours. It's fun. The market isn't moving. I can just think clearly. It's incredibly powerful. And then, because for me now, it's very easy. Like, I've been doing this. I've taken thousands of trades over the last 9 years. So for me, I'm not emotionally swayed by that stuff or distracted by it, because I know what I'm looking for. But in the beginning, it was just a nightmare for me anyway. So here I am. I'm kind of going to bring a few of these things down. There's definitely another level here I want to pay attention to. I can see it. It's a bit of a mess there. And so I'm just highlighting a couple of these levels here. Okay, so that's not bad. Let's go down to the daily and have a look at that. So trying to just get a sense of it, and I can see we've also had a bit of a support resistance level here. So this is important. This is relevant to one of the trade setups I'm potentially kind of looking at now. So I want to just draw where we are in terms of, it's a little bit choppy here. I'm going to just have a look. Sometimes I might need to do that. I'm going to drop it down. There we go. So let me just do this. I'm dropping this a little bit lower. It's not in the right place. There we go. Boom. It's actually similar to where price is now. That's pretty good. I'm relatively happy with that. I'm just keeping an eye on these areas. There's probably some other levels there, and I don't want to make it too complicated. So in fact, for the purposes of this, I think I can get rid of that line. So you'll notice what I'm trying to do is I don't want lines my brain has to pay attention to that are too far away. Okay, so that actually means I can even get rid of this one. Do I need to bring it in here? Potentially. Okay, that's it. That's more than enough. In fact, arguably, I can even now get rid of this. So what I'm actually doing is, ooh, no. Oh, no. Let's try that again. I'm laughing at myself, sorry. There we go. Done. So I've kept it nice and clean. Let's zoom in and have a look at what the market looks like now where we are. So this is good. I've got a pretty good indication of where the market is likely to go. So what does that mean? It means that if price came down here and broke through this level, it's probably going to carry on down. Okay, it's probably going to carry on down to this level, and so that gives me some potential short opportunities. It's in a downtrend. All right, so it's low. You can see that actually it's come back up. There was a level of support. This is a mess. Generally speaking, this is almost like a bit of an area at the moment where there's potential resistance. So if I had to see, so let me ask you this, and this is an important question. So take into account everything we've spoken about so far. If I then saw tomorrow, so this time tomorrow, I saw a bearish rejection candle here, maybe a red rejection candle that looks like this. Okay, if I saw that rejection candle there, that would tell me that if the next day after that it broke down, it's probably going to carry on down there. Why? Because it's kind of broken through. It's coming back up to test this level of support. It's in an area where it might find some resistance. But the only way I'm going to know if it's found resistance is if it actually gives me a strong rejection candle. So here we are. It's come up today, and it's testing this level. All right, so I'm looking for a potential rejection candle tomorrow. I think is likely. We're up here now. If price comes right up here tomorrow, because I'm looking for a trading opportunity to the downside, this is the trend. It's broken through a level of support. I'm looking to find a bearish candle here. So that would mean that it's not going to happen today. There's no way, I think, between now and the next couple of hours, the market's going to turn this candle, this whole daily candle, into a rejection candle. That's not going to work for me. So it's probably going to be tomorrow or the next day. I'm looking for a candle in this area. So if tomorrow price goes all the way up here, then there's clearly not a trade happening. But this overall trend, if this level is going to hold and it's going to head down there, I will probably get a rejection candle here telling me it's rejected this level, and then the next day it should break the low of that, and then I'll start to trade it to the downside. I will look, by the way, as I said to you, I will look to make sure that if I get in below that candle, so let me try and draw this in. Okay, so I'm just making this, I'm illustrating this. Okay, so I'll color that in. So that then becomes a bearish candle. Okay, so for the purposes of this, I'm just going to make it red for the purposes of this. Then the next day, there's another one. Then what I was going to say is then we break the low. What I'm looking for is to take profit ahead of this level here. So I will look to get in on the break of the low of that candle, put my stop loss above the high of that. And actually what's amazing about this is that this line gives me a little bit of extra stop loss protection. I could put it behind this one as well. It's like mapping the lay of the land. So these are the rivers and the flow of everything. I would put it behind that or behind this candle. So this is perfectly acceptable. That's a slightly more risk averse, looking for an entry below that and then looking to take profit ahead of this level. And then if it breaks to this level, I might then look where is the next level and then start to do that. So that's the principal idea in general about price action and horizontal levels. So I'm going to look at your questions now. I just wanted to show you where we are so far. Okay, we've got 15 minutes and I want to make sure that I cover these few items here as well. But this was a big thing. I've kind of thrown a lot of information your way. And that's the concept. That's actually trading. But I want a market that's nice and bearish. Cool. So I'm going to take a quick step away from this chart briefly to show you Kiwi. Just see how that looks. So if you look at the Kiwi chart, that's a stronger downtrend. Okay. There's also a strong support resistance level here. Okay. If I zoom out just to see if there's anything else, yes, there appears to be another level here. Okay, I like this one as well. So tomorrow, if Kiwi dollar gives me a bearish rejection candle here, I prefer this setup. Why? Because this trend, the angle of this is bearish. Okay. Yes, I can also see there's another level of support here. So that's where I would look for a bearish candle here. Actually, anywhere in this area is fine because you can see there's a level up here. There's also a level here. Anywhere in this area. And I would look then to make sure that I try to get as much profit out of this patch as possible. Okay, with my stop loss above there or potentially above there. But no, it doesn't have to be ridiculous. It doesn't have to be get out of control. So I might get a series of candles that try to get through and they reject and then it gives up and it moves. So you can sometimes get that happening. The other thing I want you to pay attention to here, by the way, this is very important, okay, is that we've got a downtrend on Kiwi dollar. We have a downtrend on cable. Downtrend happening here. Also, same thing again. There's a support resistance level. Prices come back up to that. We have a downtrend on euro dollar. Okay, there's a reason this is happening, and it's not necessarily because of Brexit. If euro dollar is going down, GBP dollar is going down, Aussie dollar is going down, Kiwi dollar is going down, it's the US dollar that's the big mover. And what I wanted you to pay attention to is we get this bias. We're living in the UK. If something happens in the markets on the pound, we assume it's Brexit. If it happens on the euro, we go, it's Brexit. But in America, meanwhile, if it moves on GBP, US dollar, they go, oh, it must be the US dollar, it must be Trump. So we have this bias because we don't often look at the big picture. So if I see a big move on GBP, US dollar, the first thing I do is look at euro dollar, Kiwi dollar, Aussie dollar. If it happened on those as well, then it's US dollar that's doing the move. So right now we're getting a strong US dollar. That's why we're getting these moves. And this is very important because when I was living in South Africa, the rand is very weak. For those of you who aren't familiar, the currency is incredibly weak. And it's partly that way because the government wanted that way because they could increase their exports because that generates a lot of money for certain people. So it was a big part of that. But it wasn't very good for anyone who's not benefiting from that because they're trying to make their very weak currency. You know, when you travel abroad and you ship bricks because you're ordering a cup of coffee in Amsterdam and it costs you like half a day's salary or a day's salary. So excuse my French, but that is the reality of the situation. So the point of this is that actually a lot of that wasn't just the weak rand. A lot of the times it was the US dollar or the pound or the euro that's stronger. You can have a strong euro, you can have a strong pound. And that's what I love being a trader. It gives me a sense of perspective. I can see a move in the market and then I can work out which currency it actually is, and then I can work out why potentially. I don't need to know why per se, but it's interesting because you do learn a lot more about that. So I wanted to show you Kiwi dollar because I really prefer that as a trade setup. If I was going to take all the trades, I have to split my risk up. So if I'm going to take 4 trades, if I'm going to take Euro dollar short, Kiwi dollar short, and GBP dollar short tomorrow, remember, I have to get bearish candles this time tomorrow night. If I don't, if price is up here, then the whole trade is negated. But if I get a bearish rejection candle tomorrow on any of those 3 charts, I'm just going to split up my risk amongst them. Okay, so that's common sense because I have the same exposure. If I take all 3 trades at 1% each, that's 3% risk on the US dollar doing whatever it wants to do. So I'd rather just put a third on each. Maybe euro dollar will go faster or whatever, but I would take all the trades because actually I must be clear, that's my personal approach. Some traders will just take whichever one they like the most. They'll just take Kiwi dollar. Some traders will take all of them but split up their risk. Okay, next on the list, higher time frames. So what I always want to make sure is the higher time frame is going in the same direction. And look at this, it's beautiful. If you just look at it, you can see the flow of money is trending down. It's very bearish. Look at that bearish candle off this level. It's trending down. Okay, so there's no doubt that the flow currently is in a downtrend. Okay, so that's higher time frame. It's the backup. You get the wind at your back because the higher time frame is going in the same direction. This is a massively big breakthrough. We often think, beginner traders think that when I say beginner traders, by the way, I'm not aiming at you guys. I'm saying that's what, in my experience, when I was getting started, what all of myself and my colleagues were thinking. Traders in the beginning of the journey thought that the lower time frames was the key to finding out where the higher time frames were going, whereas it's usually the daily that's trying to follow the weekly and the monthly, generally speaking. Okay, those are the tendencies of the market. So this is where it gets really interesting because what I can do is I can throw in, and this is coming on to the next point in my list, I'm going to throw in moving averages. I'm going to use simple, red, 50, just traditional colors. I'm going to do that because that's how the older traders in the city do them, so I like to do it the same way. Insert indicators, trend. I'm going to use 20 as well, very straightforward. Just keeping an eye on the time. We've got 7 minutes left, and I really want to make sure I cover everything that we're going to be doing with you. So far, we're doing okay. So there's a medium blue, that's my 20 moving average, and then I'm going to throw in a 10. So that's it for now. I can throw in a 200, a green 200. Maybe I'll do that just for the purposes of this. And this color, I'm sort of going to make it a lighter color so that I can see it. Is that too dark? No, you can see that. And then I'll throw in one more, which is to help me just determine the much, much longer moving averages. And then I'll have a look at your comments, and then I want to get to the last of those items there. So there we go, lime green, 200. There we go. So that's a much longer term. But the point is that the 50, this is very important. The 50, this is actually a little bit annoying. Okay, it's fine. We'll leave it for now. And the 20 and the 10 all going in the same order. So that's the flow. That's the medium term. And the shorter term is the 10 and 20 together. It's the shorter term flow of price. Because sometimes the price action here is choppy. All the candles are going up and down and up and down and up and down. We get distracted. But meanwhile, if you look at the moving averages, that's just the average of price heading down. So the moving averages help us because they can bring clarity to a situation. I go down to the daily, and if you look at it, you can see pretty much how steady the green arrow is trending down. That's the longer term average of price. The red is angling down. The blue is angling down. It's just the 10 that's very choppy. Okay, so the average of price is flowing down, which is the momentum of price. So basically, despite how choppy price action is, it is generally trending down. Okay, that's a key thing. Now, yes, it's possible for a trend to change direction. It is. But if all I do is focus on trending charts like this, I'll be right more often than I'm wrong. And that's really what trading is. So what time frame do I trade? I tend to trade the daily. I'm going to take you through gold in a moment and show you the 4-hourly and the weekly. Is there any chance? I do on occasions take on mentees. So you'll have to look me up on LinkedIn or whatever. But I don't solicit because obviously ATFX is the client here. So that's the case. Now, what I was going to say is, let me take you through a few of these. So the moving averages are really good. The next thing I want to show you, very important because I'm keeping an eye on the clock, is where I'm looking for those entries. So here's the other thing. You'll notice that, and I want to get rid of the green one here because it's just annoying me. and get rid of this to clean it up a bit. Okay, so you'll notice that, and I'll use the other one as an example quickly. So let's go to UK oil here. You'll notice that the moving average, okay, often these moving averages, the 10 and the 20 collectively can serve as a really good entry into a trend. Price goes away from the moving averages and comes back, produces a bullish candle, and then heads away, and then comes back, heads away, comes back. I can see the same thing when I actually look at US oil here. Same thing again, heads away, comes back, heads away, comes back, heads away, comes back. So the way I like to think of it is a train station. The train is leaving the station, then it comes back. So I know that ahead of time, when price is coming into the 10 and 20 moving averages in a nice trend, that's often where I should expect a potential entry into that trend if it's going to continue. So, but if it's left the moving averages, then it's too late for me. If I missed that, I have to wait for the next time it comes back, because that's where the risk is increased. So if I go look at Kiwi dollar here, you can see it's now pulled into the 10 and 20 moving averages. So that's now additional evidence. We've got a level of support resistance. We've got a downtrend in place. We've got the 50, 20, and 10 all flowing down. We also have price coming into that sell zone, that area in and around the 10 and 20 moving averages. If I then get a bearish candle, rejection candle, I'm getting more and more evidence to support the idea that I take the trade. And for me, that's really easy. Like for me, it's just muscle memory. I just see the stuff and I go, okay, it's a good trade setup. But I have to relay to you all the different things my brain is identifying in that split second. Okay, we're coming close. We've got 3 minutes left, and I want to keep an eye on the time. And I'm pretty sure you guys could probably do with a break for me. So that's moving averages. Very powerful. They help frame price and tell me where I can potentially get in and out. And trade and risk management, the idea here, I'm going to show you gold. I'm going to show you gold in a moment. One of the trades I'm sort of looking at, I'm looking at euro dollar. I'm looking at Kiwi dollar. I've told you about those two, and I'm looking at gold. I'll just take you through that. But trade and risk management, okay? It was about splitting up my risk amongst those trades. Very important. Many traders they're worried about stop losses. So the stop loss should go in a logical place. And if you stay with these webinars and I'm presenting, I'll make sure that I keep covering all these elements for you, because that's what the point of these webinars are. That's what ATFX wants for you guys. So we put our stop loss in sensible places. If I put it up here, then if price goes past here, that downtrend is done. But actually in this case, I figure if price goes above that level, I'm done anyway. So there should always be a geographic place where my stop loss should be. But most importantly, and people forget to do this to take profit, but I've been beautifully, because of the way that I've structured tonight's presentation, you understand that I'm looking to take profit before I get to that next key level. Why? Well, because historically, this level, price will bounce off that level. And I don't know what it's going to do when it gets to that level. I don't know. But the probabilities are that if it does reject this and this trend is nice and healthy, it's going to take another run towards that level. I will take my profit just ahead of it, because it could stall just before it. And that's what I'm looking to do. I would also look to take some money off the table first. So remember this, professional traders do not expect the market to give them 5% per trade. That's not how we think. We're looking in general with currencies, we're looking for 1.5 to 1. So for every 1% we risk, we're looking largely for at least 1.5% out of that trade. When we look at other things like gold, we might be looking at 3 to 1. Sometimes when currencies are trending really well, we'll get 3 to 1, 4 to 1, 5 to 1. So we'll get a lot more on that. We like small candles because of that. So we'll get a lot more on that. Let me show you gold and what I'm looking at in terms of this. So first of all, there is a downtrend on the weekly. There's clearly a downtrend, lower highs, lower lows. That's true. That's true. And if you look at it on a monthly basis, there is a level of support resistance up here. But there is also a strong trend line. Basically what's happening here is the bulls are taking a run at this level, and this is a monthly time frame. So this could take the whole of 2019 to 2020. So we could be in this for the next 18 months before it breaks out. But it's trying to break out of that. So usually I'd expect price to come down here and then up here and then up here and then break out. So that's usually what I'd look for. So what's interesting is, wouldn't it be interesting if in a year and a half's time gold breaks out of this level, and when it does, it is going to run to this level. When it does, that's where it's going to go. Okay, boom. It's just gonna, if it takes a long time, the longer it takes to go, when it goes, it's building up energy. So this is an energy build-up pattern. It's gonna burst and just head straight through to that. It'll do it in like 2 to 4 months. It'll do that whole distance, which is done here like this. This was 3 months. Boom, boom, boom. So the point is that I'm looking at it here on a weekly. We've got a downtrend, but last week's candle was really bullish. That's a very bullish candle in a downtrend. So where I'm breaking the rules, so to speak, or where it's high risk, is I'm looking at potentially, I would look, if we break the high of this candle, we might see, because of this bullish candle, which doesn't make sense in a downtrend. Look at that bullish candle. These bullish candles in a downtrend are telling me there are definitely bulls lower down. In this area, there's buyers all below this level. It tells me that price might take a run up there. So I'm telling you this because it's a higher risk trade. Go to the daily. The daily is in a downtrend, produced a bearish candle in that sell zone. So actually, believe it or not, the daily produced a sell setup. This is what I'm looking for on the other charts, but it produced a sell setup on the daily. Downtrend on the weekly, downtrend on the daily, produced a sell setup. So there's a contradiction here. The daily looks like it wants to go down. The weekly is showing it kind of wants to go up. So there's a contradiction. So this is why it's a high risk trade. But when I go to the 4 hourly, the 4 hourly is actually in a bit of an uptrend. Okay, it's producing higher lows and higher highs. This candle is particularly bullish. Only going to be about another minute, people, so if you can stay with me, I'd appreciate it. This candle is very bullish. So one of the things I have considered doing is a buy above that candle and my stop loss below the low of it. So if price has triggered me into the trade, obviously, and then if price continues, I've got quite a bit of potential profit on that trade. There's a potential profit on that trade, but listen, if the market then goes down and stops me out, I'm okay with that because I took that trade on knowing there's a weekly downtrend, so I'm going against the weekly trend. There's a daily downtrend, but there was a strong weekly candle and a strong 4 hourly candle. So I've got completely 50-50 signals here. Whereas on the other trades I've shown you, the euro, the kiwi, there's almost all bearish signals that are saying I want to head down. And a bearish rejection candle tomorrow would support that. So there we go, ladies and gents, to sum up. Price action, trending, not trending, candlesticks, bullish, bearish, indecisive, horizontal levels, higher time frames, moving averages, trade and risk management. And these are key books that I want you to take care of and obviously see if you can read through this. This one's an easy read. That's a nice easy read. Not a very long one, very simple, easy language, and very cool, very beneficial. Market Wizards books is just fascinating. Okay. Let me go back to the last slides to take you through this and read your questions, your last questions here, okay? Yeah. So this is being recorded. I will upload the recording. I believe that it may be in on the YouTube channel. So don't hold me to that, but I believe if they've loaded up the previous ones, they will load this one up as well. And then yeah, so just have a look. I'm always on LinkedIn and Twitter where I talk about my trades, but you'd have to find me out. It's just anyway. So you're most welcome. Have a look at this. So I know that they're going to upload this, and it's very good. So just for those of you who aren't familiar with ATFX, obviously they're regulated by the FCA. Obviously an efficient, secure, easy to use payment portal. They're committed to providing competitive prices for our clients, and global investors obviously using most widely used platform, that's MT4. What I love about MT4 here is, of course, is that if you can develop robots to trade, you can also trade through the MT4 platform. That's a big bonus, which means that you could combine both robotic trading and EAs. Lots of people don't know how to do that, so they do discretionary trading. Some people only know how to do that. There's everything. There's something for everyone. Bespoke customer service and trade support for client trading needs, 24/5. Okay, so, and of course, I'm here exclusively for ATFX as well, so just keep that in mind. I do enjoy doing these webinars. I love the interaction. I've spent the whole day at home talking to myself, so that's why I'm so chatty now. So obviously, here are the contact details. If you do have any questions or you need any assistance at all, please do not hesitate to get in touch with the lovely people at ATFX. They're in the city. And again, I look forward to seeing you in these future webinars, really do. And come prepared with questions. So if it's me, you can feel free to ask any questions you want, any markets you want me to have a look at. I'm more than happy to do that. I really wanted you to get a sense of what actual practical trading is. This is how we do it. But we choose the markets we get involved in. Then we can see what our potential risk is, where we're going. We can see how much potential profit there is on a trade. And then we look at price action to support that. Okay, so there is a lot of common sense in trading, and that's the way it is. So, my full name is Adam Peter Harris, by the way, Adam Harris. And obviously you know me from Trade with Precision, so we're a separate company where we're real traders. Okay, so we come in. It's nice because we get to be able to provide trader experience. Okay, so it's been an absolute pleasure. So thank you so much, ladies and gents. And if you enjoyed it and you want to give some positive feedback to ATFX, please do that. They always like to know that, and so that's really good. And I really enjoyed it. So thanks a lot. What I'm going to do is I'm going to end the webinar. That's not me. I haven't just gone anywhere. I'm going to end the webinar, but it's going to hoof us all out. I want to wish you a wonderful evening, and I look forward to seeing you in future webinars. So thank you very much. All right, have a good one.